Tariffs, wars, markets up, markets down. What a fun ride. Hey, at the end of the day here, what's interesting about all of these tariffs and wars and the fact the market's going up and down is no one's even factoring in some of the more important stuff that you need to learn. And what I mean by the more important stuff you need to learn, I want to teach you something right now that you probably have never heard of before. And you probably say to me, what, have you lost your mind? But the reality is I haven't. So I want to tell you that average rates of return are actually a lie. Yep, average rates of return are a lie. So I want to prove that to you right now. I want to show you what happens here if we do a comparison on average rates of return. So here's my deal. I'm going to get you an average rate of return of 25% per year, guaranteed for the next 4 years. Want to do business with me? Of course you do. So take a look here. I'm going to get $100,000. I'm going to invest it. And in the first year, I'm going to make 100% on my account. I'm going to have $200,000. The second year, I'm going to lose 50%. I'm going to have $100,000. The third year, I'm going to make 100%. I'm going to have $200,000. The fourth year, I'm going to lose 50%. And I'm going to have $100,000. Now, I want you to take a close look here. We've got 100%, 100%, and two negative 50s. If we add those together, we come up with a positive 100. We divide by 4. Our average rate of return was 25%. So 25% average rate of return over that period of time, we still ended up with the exact same amount of money we started with. And this isn't counting in fees, taxes, so on and so forth. So is average actually true? And the answer is no. You see, if there's one negative year inside of there, it isn't true. Haven't you wondered why when you look at your 401k and you apply the rule of 72, why you don't come out to the numbers they say they did? Because see, it only takes one negative year before that number is actually not true, and you're not factoring in taxes, inflation, so on and so forth. So what's the catch here? Well, the catch is it's more important to avoid the losses than it is to pick the winners. So if I could show you a way that you could avoid those losses, and not only avoid those losses, be able to do that in a tax-free environment where you could get most of the gains in the market, never participate in losses, and when you die, to pass on it 2 to 3 times that amount tax-free, isn't that something you'd want to do? So let's take a look here. Let's go over here. And what I want you to understand is that if we go out and we look at what's out here, we've got these qualified plans, okay? And if we look at these qualified plans, what we know is that if we wanted the perfect investment, our perfect investment would be, it would grow tax deferred, it would come out tax free, we'd have competitive rates of return, we'd have high contribution limits, we might get some additional benefits, we might be able to leverage the money, like collateralize it, it'd be safe, there'd be no loss provisions, it'd have guaranteed loan options, unstructured loan payments, liquidity, use, and control, and we'd be able to deduct all that stuff. Well, if we look at our qualified plans out there, the reality is that they don't come to us tax-free distribution, but they do grow tax deferred. We do have fairly high contribution limits, but not really. We have limitations on how much we can put in. There really are no additional benefits. We definitely cannot collateralize it. Unless we invest it correctly, it's probably not safe. There are no loss provisions, no guaranteed loan options. No unstructured loan payments. There's no liquidity, use, and control. But we can deduct it, okay? So we get 3 out of all these choices. Is that what you really want inside your investment? Well, what if I told you there was a better way, all right? So the better way is to use something that's called a properly maximum funded life insurance policy under TEFRA, DEFRA, and TAMRA. Now, what does that mean? Well, you see, the average person says they have life insurance when in fact they don't. What they have is they have death insurance. They bought the most insurance using the least amount of money for the purpose of dying. Now, of course, they didn't really know because that's the only choice they were ever given. And that's what the insurance company said. They said, buy some of this life insurance, when in fact what they meant to say is, buy some of this death insurance. But you see, if they called it what it is, nobody would buy it. So there's lots of different ways to build these things. So we're going to start off here, and we're going to start off with how does that really work? Well, there's the minimum amount of money one can pay to get any particular amount of coverage. And there's the maximum amount of money one can pay to have that same amount of coverage. The minimum premium is determined by the insurance company. You give me this much money, I give you this much insurance. But the maximum premium is determined by the government. Now that right there should be ding, 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 ding. What's that all about? Okay? Because the reality is why is the government concerned about how much money I put in a life insurance policy, and why is that really important? Well, there's infinite designs. I mean, we can go out here and we could put in different amounts of premium and different amounts of minimums and different amount of maximums. But in 1980, the government decided to pass a law limiting how much money one could put inside of a life insurance policy. Now, the reason why that was not allowed life insurance contracts to have an advantage over traditional qualified plans. You see, they put these ERISA plans in place, 401ks, 403bs, so on and so forth, and nobody was putting their money in them because they could go out and put it in a life insurance policy, grow their money tax-free, access their money tax-free, and do very, very well, and then pass it on tax-free. So they changed the rules. So there's some real similarities between them and some real differences. So in the qualified plan, the 401ks, etc., your contributions are put in before taxes, so you actually get a tax deduction. Whereas a life insurance policy, they're put in after taxes. In the qualified plan, we have limits on how much money we can put in, and those limits are set by our business partner, the government. There are no limits on how much we can put in a life insurance policy. As a matter of fact, most people will never hit their insurability limits. The money that is inside of a qualified plan grows tax deferred, and the money that's inside a life insurance policy grows tax deferred. All money that comes out of a qualified plan is 100% taxable, and the death proceeds and all money taken out of a life insurance policy, if accessed correctly, comes out tax-free. The money taken out of a qualified plan has a 10% penalty for coming out prior to 59.5 and a 25% penalty if you don't take it out. And inside a life insurance policy, I have access throughout the entire period of time. I have liquidity. I can access up to 85% anytime I want. And if I choose to, I can put it back, whereas in the qualified plan, I will not be allowed to put it back. Policies with premium above the maximum allowable contribution by federal government are deemed MECs, or modified endowment contracts, requiring the policy to be treated like a qualified plan with the same rules, regulations, and penalties. The only difference is in a MEC, when I die, that money passes on tax-free, but I don't have those tax benefits that I would have had otherwise had I built the policy properly. While we're talking about qualified plans, let's talk about what they do. You see, qualified plans do two things. They defer the taxes, but more importantly, they defer the calculations. Now, everybody I've ever talked to, after learning about where the national debt is and where taxes have been in the past, all agree on one thing. Taxes are not going to get lower. As a matter of fact, they're not going to stay the same. They're going to get higher in the future. So you're deferring your money, and the reason why is because they told you should put money inside of a tax-deferred account and growing money you would have otherwise paid in taxes, and in the end you'll have more money because you're going to be in a lower tax bracket. But most people are very surprised when they sit down and we do a financial MRI for them and we show them exactly where they're at and where they're going. They're very surprised to find out that not only will they not be in a lower tax bracket later on in life, frequently they'll be in a higher one. And if they're married, it's almost guaranteed, because when one party dies, the other one has to file single. A more accurate statement would be to postpone the taxes or tax calculation. The first question you should be asking yourself is, what tax bracket will you be in when it comes time to withdraw the money? In other words, what's your exit strategy? The second question is, what deductions will you be taking when it comes time to take the money out? And the reality is most people get rid of their three largest tax write-offs, which is their mortgage, kicking the kids out of the house, and making contributions into those accounts. So let's assume you want to purchase $500,000 worth of death insurance, okay? Well, if we were to go out and do that, the minimum that we would pay into that would be $500. Yet the maximum would be $10,000. Well, this would actually offer a question about which one of those is better. And in the immediate moment, if you were to look at this, it's certainly better to pay $500 for $500,000 worth of coverage than it is to pay $10,000, unless you know the rest of the story. And you understand that you can grow your money tax-free, access up to 85% at any time tax-free, put it back if you want, get most of the gains of the market, never participate in losses, and when you die, it passes on at 2 to 3 times that amount tax-free. Now suddenly, that $10,000 looks much more appealing. The lowest premium for coverage is called a term insurance policy. Term offers only one benefit, and it's called a death benefit. In other words, death insurance. By the way, only 2% of all term insurance policies are ever paid. Now, let's forget the insurance for one moment and talk about the benefits. So when we're looking for a place to put our money, it makes sense to look for the most benefits possible. Remember that chart that we had over there? If you could wave a magic wand to get all the benefits that you want, I would bet you'd want to grow your money tax deferred. You'd want to access your money tax free. You'd want competitive rates of return. You'd want high contribution limits. Additional benefits like maybe leverage the money or do something along those lines. You'd like to be able to collateralize the money. You'd like it to be safe. No loss provision. Guaranteed loan options. Unstructured loan payments. Liquidity use and control. And then you'd like to be able to deduct it. Well, folks, you know what that is right there? That's called a unicorn. That does not exist. But what if I told you you could get all of that, okay, through life insurance except for one thing? So let's get back to that life insurance for a second. And what we're going to do now is we're going to buy the least amount of death benefit using the most amount of money, and we're going to keep that under that MEC line. So we're going to follow that TEFRA, DEFRA, and TAMRA, and we're going to be able to get everything except we're not going to be able to deduct the contributions. So once again, I get to grow my money tax-free, access up to 85% of it at any time tax-free, put it back if I want, get most of the gains of the market, never participate in losses, and when I die, it passes on to 2 to 3 times that amount tax-free. Wouldn't you want to do that? And how much money would you want to put in that environment? The only benefit cash value coverage does not have is I don't get to deduct the deposits that I put in. Life policies offer maximum amount of benefit and perform at their maximal potential with premiums up to but not over the government allowable amount, which is called a maximum efficient contract. Yes, it's still a MEC, but it's maximum efficient contract as opposed to a modified endowment contract. Now, folks, I could sit here and spend literally hours talking to you about how this works. But what you need to do at this point is you need to continue your education. And there's several ways for you to do this. One would be to set up a no-cost, no-obligation meeting, get together so we can do a financial MRI for you to figure out whether this works for you. Maybe you've got this figured out. You want to do this. Go out to our website. Go out there and find our courses on life insurance, specifically on life insurance. Go take that course on life insurance. But whatever you do, reach out and let's find out, does this actually make sense for you? Remember to live like you're going to die tomorrow and plan like you're going to live forever because you just might. Be sure to subscribe to our channel below. And listen, give us some comments. Was this video helpful to you? And if it was, share it with friends, family, because we need to turn this world right side up. We need to make sure that going forward, people are proactive when it comes to their planning and that they're growing their money tax-free. Remember to keep smiling, drive really fast, and I look forward to meeting each and every one of you in the not too distant future.